In today's brutal mortgage market, so many people get rejected over and over again before using these 5 strategies. The difference between denial and approval, these 5 mortgage hacks that most banks hope you never discover. Welcome back to the channel. If you don't know me yet, my name is Will. I'm a former corporate chief financial officer with an MBA in finance from Cornell University, and I'm a chartered financial analyst. I've spent decades analyzing financial markets and helping people and companies make smarter money decisions. And let me be clear, the mortgage landscape in 2025 is more challenging than anything we've seen in years. With interest rates still hovering near decade highs and banks tightening their standards like never before, getting approved for a mortgage feels almost impossible for many first-time buyers. But after a thorough analysis to find what actually works for successful applicants, I've identified the strategies that make all the difference. What most people don't realize about the mortgage approval process is that it's not actually about how much money you make. It's about how you present yourself to lenders. Today, I'm sharing the 5 specific strategies that have helped people go from high-risk applicant to dream borrower in just 90 days. And just wait until you hear strategy number 5. Less than 2% of applicants know about this technique, but it's completely changed the results for thousands of home buyers. So let's get into it. Hack number 1, improve your credit score. Let's start with the foundation of any mortgage application, which is your credit score. But forget everything you've heard about just paying your bills on time. Here's what actually moves the needle in 2025. Most people don't realize that mortgage lenders use a completely different scoring model than what you see on Credit Karma. It's called the FICO mortgage score, and it weighs factors differently than the standard score most consumers monitor themselves. The FICO mortgage score weighs factors like credit utilization and payment history more heavily. So here's what smart applicants do. First, they address credit utilization, which is 30% of your FICO score, immediately. Even if you pay off your balance every month, the credit bureaus take snapshots when your credit utilization is high, which can hurt your mortgage-specific score. The most effective approach is what financial experts call the zero balance reporting trick. Pay off your cards completely, wait 2 or 3 days, then request your credit report be pulled. This simple timing strategy can boost scores by 10 to 50 points almost immediately. Next, ask your mortgage provider about a process called rapid rescore, where they can request an immediate credit report update after you've made positive changes like paying off your credit card, rather than waiting for the normal 30 to 45 day cycle. And here's something most financial advisors won't tell you. Using specific, professionally worded goodwill letters can sometimes remove late payments from your credit history. Even though the success rate is low for this idea, it's worth trying anyway. These techniques can help improve your score, say from 620 to 680, in as little as 30 to 60 days, depending on your profile. And that can be a game changer in today's market, where lenders often want 680 or higher for the best rates. Hack number 2, improve your debt-to-income ratio. The second major hurdle in today's mortgage market, your debt-to-income ratio, or DTI ratio for short. In 2025, banks are scrutinizing this number more intensely than ever before, and as a result, it's tripping up more applicants than ever before. Most people don't realize that lenders have a hard cap at 43% debt to income for qualified mortgages, meaning your debt cannot be more than 43% of your income. And with interest rates where they are, many applicants are hitting this DTI ceiling without understanding why they're being rejected. Here's where understanding personal finance makes all the difference. Instead of just paying down debt, which takes time, smart applicants also work to boost the income side of their equation with these 3 practical strategies. First, document side hustle income. Most lenders will count consistent side income if you can document it for 2 years. But here's the insider hack. A properly structured letter from a CPA, your tax accountant, verifying income stability can sometimes allow you to include income that you've only been earning for 9 to 12 months. Second, explore opportunities to earn rental income. Even income from taking on a roommate might be counted towards your DTI ratio if structured correctly. You don't always need a formal lease. Sometimes bank statements showing consistent deposits over 12 months can suffice, and lenders may count 75% of that as income. Finally, if you have a student loan, explore restructuring options immediately. Income-driven repayment plans like the SAVE plan can lower monthly payments based on your income. For example, it's not unheard of to reduce the student loan payment from $600 to $250, which improves your DTI ratio. These strategies can make a big difference, potentially qualifying you for a larger loan or better terms. But the next tip is all about making your application really stand out. And that's hack number 3. Improve your application documentation. This third secret to mortgage approval in 2025 is what financial experts call documentation mastery. In this market, how you present your financial story matters almost as much as the numbers themselves. Studies of rejected applications have found that most people simply submit the minimum required documents. This is a critical mistake. What works is creating what I call a financial biography package. Smart applicants create a cover letter explaining every potential red flag in their application before the underwriter can question it. For example, if there's a gap in your employment in the past several years, don't hope they won't notice. Include a detailed explanation with any supporting documentation you might have. Here's the psychology of this. Bank underwriters are looking for reasons to reject applications, but by acknowledging potential issues up front, you transform yourself from a risk into a transparent, trustworthy applicant. Another smart move is including bank statements going back 24 months instead of the required 2 months. This shows consistency in finances that the minimum documentation simply cannot capture. Last but not least, the most powerful piece of documentation is to prepare what financial experts call a housing payment verification history, which is simply proof of on-time rent payments for 24 consecutive months, formatted to look exactly like a mortgage payment history. Banking professionals say that application packages containing all this information stand out dramatically from typical submissions. But the game changer for many successful homebuyers comes from this next strategy. Hack number 4, use a lender matching strategy. This fourth strategy might be the most important of all, what finance experts call the lender matching strategy. Most people shop by interest rate alone, which is a fundamental mistake in 2025's challenging market. Each bank has what's called overlay requirements, which are additional restrictions beyond standard guidelines. Some lenders avoid self-employed borrowers, others specialize in them. Some have strict credit score cutoffs, while others will work with lower scores for the right profile. Given that different lenders look for different profiles, the smart approach is to create a spreadsheet of at least 15 different lenders and map their specific preferences against your borrower profile. Credit unions and portfolio lenders who keep loans on their own books have much more flexibility than big banks. So get to work. Study websites, make phone calls to local banks, big banks, credit unions, and other lenders that you can find with Google searches. Fill out that spreadsheet with information about what each lender wants. Here's an insider secret most financial advisors won't tell you. Many local credit unions offer special mortgage programs for first-time buyers in specific counties. Their debt-to-income requirements can be 5% higher than conventional lenders, and they often count retirement accounts differently in asset calculations. So don't overlook these lenders. When approaching these specialized lenders, use this exact phrase. I'm interested in your portfolio lending options and wonder if you have any special programs for someone with my profile. This tells them that you're an informed borrower looking for a relationship, not just a transaction. Financial psychology studies show that loan officers are much more likely to go off script and share special rate buy-down programs they rarely advertise. Home buyers have secured mortgages with rates almost 0.5% lower than advertised rates simply by using these lender matching strategies. And I haven't even told you yet about the down payment strategies that typically save people $15,000 to $20,000. Hi, a quick interruption. If you're finding this video helpful, please hit that like button down below and be sure to subscribe too to join me as I explore more subjects in personal finance. And be sure to drop a comment below this video with your biggest question about mortgages. I'll answer if I can, but often other people in the community will answer too. Thanks for your support. Now, back to the video. Hack number 5, be strategic with your down payment. This fifth strategy that transforms mortgage applications is strategic down payment planning. Most people think it's just about how much money you put down, but in 2025, how you structure your down payment can be worth tens of thousands of dollars. Financial planners call this the layered funding approach. Instead of putting down a simple 5% from savings, combine multiple sources for the down payment to reduce your out-of-pocket costs while looking stronger to lenders and improving your loan terms. First, research all available down payment assistance programs in your state. Most states have 3 to 7 different programs, but most applicants only check 1 or 2. These programs could be for grants or forgivable loans, some up to $15,000 that may not require repayment if you stay in the home long enough. This could be essentially free money for you. All you have to do is go find it and apply. Apply early though, because funds often run out mid-year, and check eligibility too for income or home price limits. Next, use your retirement funds as reserves, but without actually withdrawing from them. Lenders count 60 to 100% of your 401k or IRA balances as part of your financial reserves, which boosts your application's strength even though you never touch the money. The third element that smart home buyers use, if they can, is family gifting, but with a twist to the documentation. Instead of just getting a standard gift letter, which states that the money is not expected to be repaid, have the family member who made the gift to you include in the letter the reasons they gave you the funds now rather than as an inheritance later. The reason could be as simple as they want to help you buy the home or start a family. Providing an explanation for the gift helps reassure the lender that it truly is a gift and not a disguised loan. Fourth, be strategic about timing. Different down payment sources have different seasoning requirements, meaning how long the money needs to be in your account. In general, you'd like the money to be in your account for 2 or more months. By carefully timing when each source enters your account, you can avoid the large deposit flags that trigger extra scrutiny by the lender. And finally, consider government-backed loans like FHA or VA, which require as little as only 3.5% or even 0% down payment, depending on the program. Combining these assistance programs can mean putting down little to nothing from your own savings while still qualifying for a conventional or FHA loan. The end result? Many successful buyers qualify for conventional loans with only 3% down from actual savings, while appearing to lenders as much stronger borrowers. So in conclusion, with these 5 hacks, your application will be ready and stronger than ever. But before you take out a mortgage, make sure you understand the cost of what you're about to get into. Watch this video next to learn how mortgages work and how to save thousands, if not hundreds of thousands of dollars on interest costs. So there you have it. The 5 expert strategies that have helped countless people go from rejection to approval in one of the toughest mortgage markets in decades. When you understand the system and how to position yourself within it, homeownership is still very much in reach.